the company you rarely notice, but the economy cannot ignore. Imagine waking up one morning and reading the headlines. A new metro line has been inaugurated in a growing city. A mining company has expanded its operations. A large infrastructure project has begun connecting remote regions. Defense manufacturing is increasing, and industrial corridors are taking shape across the country. Now pause for a moment and ask yourself a simple question. When we see these massive projects becoming reality, who actually builds the machines that make all of this possible? Most of us naturally think about the finished product. We admire the metro train gliding through the city. We drive on newly constructed highways. We hear about mines producing coal or iron ore. We read about advances in defense manufacturing. But very few people stop to think about the heavy engineering companies working quietly behind these achievements. Those companies rarely make newspaper headlines. Their advertisements rarely appear on television. Yet without them, many of these projects would never leave the drawing board. One such company is BEML Ltd. Today, we're not simply discussing another listed company. We're exploring a business that has spent decades building the equipment that powers some of the country's most essential industries. The interesting part is that BEML isn't a company most retail investors talk about every day. It doesn't produce smartphones. It doesn't sell consumer products. It doesn't own fashionable digital platforms. Instead, it operates in a world of giant machines, industrial engineering, specialized manufacturing, and complex projects that most people never get to see. Ironically, businesses that stay out of the spotlight sometimes become the backbone of an economy. Think about constructing a house. When guests visit, they admire the paint, the furniture, and the decorations. Almost nobody compliments the steel bars hidden inside the concrete. Yet everyone knows that without those invisible structures, the entire building would collapse. Industrial companies often play a similar role. Their work remains hidden beneath the surface, but the economy quietly depends upon them every single day. This brings us to one of the most useful investing ideas. Never judge a company by how visible it is. Judge it by how essential it is. Some of the world's greatest businesses have never been household names because they sell products to industries rather than directly to consumers. BEML belongs to that category. Now let's understand what this company actually does. Imagine you own a gigantic construction company. One day, you're awarded the responsibility of preparing land for a large metro project. Another day, you're working on a mining project. Next month, you're supplying equipment for defense logistics. Later, you're helping develop railway infrastructure. Would ordinary commercial vehicles be enough? Of course not. These projects demand machines capable of lifting enormous loads, operating under extreme conditions, and functioning continuously in environments where failure isn't an option. This is where BEML enters the picture. The company manufactures heavy earth-moving equipment used in mining and infrastructure. It produces specialized vehicles for defense applications. It manufactures coaches and engineering products for metro and railway systems. Over the years, it has also expanded into newer technologies, advanced mobility solutions, and export markets. Instead of depending on just one industry, BEML has built its presence across several sectors that support long-term industrial development. This diversification is important because every industry experiences cycles. Sometimes mining grows rapidly while infrastructure slows. At other times, railway investments accelerate. Defense projects often follow their own timelines. By participating in multiple sectors, the company attempts to reduce dependence on a single source of demand. That doesn't eliminate business risk, but it creates multiple avenues for future growth. Now let's zoom out even further. Economies, much like living organisms, require continuous investment to remain healthy. Cities become larger. Transportation networks become more complex. Industries require raw materials. Manufacturing demands logistics. Energy projects require equipment. Urban populations need efficient public transport. every one of these developments creates demand for engineering capability. This leads us to another powerful mental model known as the picks and shovels principle. During the famous gold rush, thousands of people searched for gold. Many failed, but businesses selling picks, shovels, boots, and equipment often earned steady profits because every miner needed their products regardless of whether gold was eventually discovered. Modern economies work in a surprisingly similar way. Some companies build factories, others extract minerals, others manufacture trains. But all of them require specialized equipment before they can begin their work. Instead of competing with mining companies, infrastructure developers, or railway operators, businesses like BEML supply the tools that enable these industries to function. This doesn't automatically make them superior investments, but it changes how we should think about them. Rather than asking, will this individual project succeed? Experienced investors often ask a broader question. If this entire industrial ecosystem continues growing over the next decade, which companies quietly benefit from almost every stage of that journey? That shift in thinking is incredibly powerful. Instead of chasing individual stories, you begin looking for businesses participating across multiple long-term trends. Today, several structural trends are influencing industries where BEML operates. Urbanization continues, increasing demand for public transportation systems. Industrial development requires more mining and construction equipment. Manufacturing growth encourages investments in heavy engineering. Export opportunities are expanding for companies capable of producing specialized industrial products. Defense modernization creates demand for advanced engineering solutions and specialized vehicles. None of these trends guarantee success for any particular company. That is an important distinction. A favorable industry creates opportunities, but opportunities alone do not create shareholder wealth. Execution does. Imagine two farmers receiving identical land, rainfall, and seeds. One manages the farm efficiently and produces an excellent harvest. The other wastes resources and struggles despite having the same opportunities. The environment remained identical. The outcome depended upon execution. Businesses operate in much the same way. A growing industry may provide the wind, but management still has to build the sails. This idea introduces another mental model that every investor should remember. Tailwinds can accelerate a business, but they cannot replace good management. If management allocates capital wisely, develops competitive products, controls costs, and executes projects efficiently, industry growth can amplify shareholder returns. If execution is poor, even a favorable environment may fail to produce meaningful results. Understanding this distinction prevents investors from confusing an attractive story with an attractive investment. And that's exactly where BEML's story becomes fascinating. The company is positioning itself across industries expected to remain relevant for many years. It is expanding manufacturing capabilities, strengthening its presence in defense and rail transportation, developing new engineering products, and pursuing export opportunities. On paper, that sounds encouraging. But investing isn't about buying stories. It's about determining whether those stories eventually become stronger revenues, healthier margins, growing cash flows, improving returns on capital, and ultimately greater shareholder value. Because markets eventually stop rewarding promises. They reward execution. So before we decide whether BEML deserves a place in a long-term investment portfolio, we need to go much deeper. Who are the customers that keep this business running? How does the company actually make money? Why has its business model evolved over the years? And perhaps most importantly, does the future being built inside BEML's factories have the potential to create long-term wealth for shareholders? Or is the market already pricing in too much optimism? Those are the questions we'll begin answering in the next chapter, where we step inside BEML's business itself and understand what truly drives this engineering giant. The three engines that could power India's next decade. Now imagine something with me. Suppose tomorrow morning, the government of India announces a massive package. New metro corridors in 10 cities. More Vande Bharat trains. Higher defense spending. Expansion of coal production. New mining blocks. Modernization of military logistics. High-speed rail corridors. Now ask yourself one simple question. Which single company would benefit from almost every one of these announcements? Very few companies have that kind of business profile. And that's where BEML becomes interesting. Not because it dominates one industry, but because it quietly sits at the intersection of several industries that India wants to expand simultaneously. This is one of the most powerful ideas in investing. Sometimes investors search for companies that dominate one market. Sometimes the bigger opportunity lies in companies that participate in many growing markets at the same time. Think of it like standing at a busy traffic intersection. A shop located on one street only serves people traveling on that road. But a shop located where 4 highways meet naturally receives traffic from all directions. BEML resembles that intersection. Its businesses are spread across mining, defense, railways, metro systems, aerospace, and engineering. If one sector slows temporarily, another can compensate. Not perfectly, but enough to make the business more diversified than many investors initially assume. Let's begin with the oldest part of BEML, mining and construction. At first glance, this doesn't sound exciting. People usually associate mining with dust, giant machines, and remote locations. But mining is actually where every industrial economy begins. Take your mobile phone, the steel in your apartment, the copper inside electrical wires, the aluminium used in airplanes, the coal powering industries. Everything starts beneath the ground. Mining isn't glamorous. It's foundational. And here's an interesting mental model. Imagine baking a cake. Everyone admires the finished cake. Almost nobody thinks about flour. Yet without flour, there is no cake. Mining plays a similar role in an economy. It rarely grabs headlines. But without it, factories stop, infrastructure slows, and manufacturing struggles. Now think about the machines needed to extract those minerals. You cannot dig modern mines with ordinary trucks. You need specialized dump trucks, excavators, rope shovels, graders, heavy earth-moving equipment. This is where BEML has spent decades building expertise. The company isn't selling consumer products. It is selling productivity. Every machine it manufactures is essentially a money-making asset for its customer. If a mining company buys a massive dump truck, it isn't purchasing steel. It is purchasing the ability to move thousands of tons of material every day. That's an important difference. Customers don't buy the machine. They buy the future income the machine can generate. Understanding this changes how you look at industrial businesses. Now something interesting is happening. The company isn't just manufacturing traditional mining equipment anymore. It has started moving towards electric dump trucks. At first, this might sound like another corporate announcement. But pause for a moment. What happened in passenger cars over the last decade? Electric vehicles slowly moved from being experiments to becoming mainstream discussions. A similar transformation may eventually happen in heavy industrial equipment. Mining companies across the world are under increasing pressure to reduce emissions, improve fuel efficiency, and lower operating costs. If electric technology succeeds in heavy equipment, early manufacturers could enjoy a significant advantage. Notice the pattern. Good companies don't wait until industries completely change. They prepare while the change is still unfolding. That's exactly what long-term investors should look for. Now let's move to the second business. Railways and metro. Whenever people hear Indian Railways, they immediately think of trains. But trains are only the visible part. Behind every railway system lies an enormous engineering ecosystem. Tracks, signaling, rolling stock, manufacturing facilities, maintenance, components, testing, technology. Think about your own daily life. If a city builds a metro line, what actually changes? traffic reduces, travel time decreases, businesses expand around stations, real estate values improve, employment opportunities rise, urban productivity increases. One metro project influences thousands of businesses indirectly. That's why governments continue investing in rail infrastructure. Not because trains are fashionable, but because transportation improves economic efficiency. And efficient economies usually become richer economies. BEML has quietly positioned itself inside this ecosystem. It has supplied metro coaches, rail coaches, driverless metro technology, and more recently, it has entered the Vande Bharat ecosystem. Now here's something worth understanding. Whenever a company participates in projects like Vande Bharat, investors often become excited. But experienced investors ask a different question. Will this become a one-time order or a repeatable business? This is an extremely important distinction. Imagine you own a bakery. If someone buys one cake, that's good. But if they place an order every week for the next 10 years, your business becomes far more valuable. Stock markets reward repeatability more than one-time success. The same principle applies here. The real opportunity isn't building one train. It's becoming part of India's long-term railway manufacturing ecosystem. Management has also invested in facilities dedicated to high-speed rail manufacturing. Again, many people look only at today's profits. Professional investors often look several years ahead. Factories are built before demand peaks. Capacity comes before production. Investment comes before revenue. This brings us to another useful mental model. Plant the tree before you need the shade. Imagine waiting until summer arrives before planting a tree. By the time it grows, summer has already passed. Businesses work exactly the same way. Capacity must be created before demand fully arrives. If management waits until every order has already been received, it is already late. So when BEML expands manufacturing capacity today, management is effectively making a bet on India's future infrastructure demand. Whether that bet proves correct will determine future shareholder returns. Now we come to the business that could redefine BEML over the next decade. Defense. This is where the story becomes much more interesting. For many years, India relied heavily on imported defense equipment. But over time, a strategic realization emerged. National security cannot depend entirely on overseas suppliers. Wars across the world reinforced one lesson. Countries capable of designing and manufacturing their own defense systems enjoy greater strategic independence. That's where the government's push for indigenous defense manufacturing becomes important. And BEML already possesses decades of relationships, engineering capability, and manufacturing infrastructure. Instead of starting from zero, it begins from experience. The company is involved in high-mobility military vehicles, armored recovery vehicles, support equipment, missile-related components, aerospace structures, military engines, ground support systems. If you notice carefully, these are not products purchased every weekend. These are specialized systems with extremely high entry barriers. A small startup cannot suddenly decide to manufacture military mobility platforms. The technology, testing, certification, manufacturing, and government approvals create natural barriers against new competitors. And businesses protected by high entry barriers often enjoy stronger competitive positions. Let's understand another mental model. Imagine opening a roadside tea stall. Anyone with modest capital can compete. Competition becomes intense. Margins stay low. Now imagine manufacturing military recovery vehicles. How many competitors can enter overnight? Almost none. The harder it is to enter an industry, the more valuable existing capabilities become. This concept is called an economic moat. Think of a medieval castle. The castle survives because enemies cannot easily cross the moat surrounding it. Businesses also build moats, sometimes through brands, sometimes through technology, sometimes through distribution. sometimes through regulation, and in defense manufacturing, certification, engineering expertise, and long-standing relationships often become that moat. But management isn't stopping there. Another interesting shift is happening. Exports. Historically, BEML depended largely on domestic demand. Today the company is gradually expanding overseas. Equipment has already reached dozens of countries. Now why does this matter? Because export markets provide something every investor likes. Diversification. Imagine you own a shop with only one customer. Losing that customer becomes disastrous. Now imagine serving customers across 50 countries. Risk naturally reduces. Export growth doesn't simply increase revenue. It also reduces dependence on one geography. That makes future earnings potentially more resilient. Now let's discuss management. Whenever investors analyze a business, they usually ask, is management honest? That's important. But another question is equally important. Is management allocating capital intelligently? Because honest management making poor investment decisions can still destroy shareholder wealth. Let's see what BEML's management appears to be doing. Instead of distributing all profits, they are investing. New manufacturing plants, research facilities, technology, electric equipment, high-speed rail, defense expansion, warehousing, capacity building. Whether every project succeeds remains uncertain. But the direction is clear. Management appears willing to prepare for India's next industrial cycle rather than merely protecting today's business. That is encouraging. However, there is another side. Investment alone never creates shareholder wealth. Returns on investment do. Imagine spending 100 rupee to build a new factory. If that factory eventually generates 300 rupees, it was an excellent decision. If it generates only 70 rupees, shareholders become poorer despite impressive announcements. This is where investors must separate headlines from economics. Announcements are easy. Returns are difficult. So when management speaks confidently about future products, capacity expansion, new defense platforms, rail opportunities, and export growth, don't immediately become emotional. Become curious. Ask one question repeatedly. Will these investments eventually improve earnings, cash flow, and return on capital? Because that's where the market eventually focuses. Not on presentations, not on ceremonies, not on inauguration photographs, but on numbers. In investing, hope starts the journey. Execution finishes it. And that's exactly where our story goes next. Because in the next chapter, we'll stop looking at factories and products and start examining the company's financial heartbeat. We'll decode why a business with such exciting opportunities still struggles with profitability at times, what its financial statements are really trying to tell us, and whether BEML is becoming a classic case of great story, average numbers, or whether the numbers are quietly preparing to catch up with the story. The numbers behind the narrative. Is BEML a value trap, a value creator, or a business waiting for its moment? Imagine you walk into a beautiful restaurant. The ambience is fantastic. The menu looks premium. The chef has won awards. The waiters are polite. The kitchen is modern. Everything looks perfect. But then you taste the food, and something feels missing. Would you immediately buy the restaurant? Probably not. Now imagine another restaurant. It doesn't look glamorous. The tables are old. The menu is simple. But every customer leaves happy. People keep returning. Profits keep growing. Which restaurant would you rather own? Most successful investors choose the second one. Because businesses are not judged by appearances. They are judged by economics. And this brings us to one of Warren Buffett's favorite ideas. Price is what you pay. Value is what you get. Notice something interesting. He didn't say, cheap is always good. He said, value. There is a huge difference. And today, as we open BEML's financial statements, we're trying to answer exactly that question. Is BEML creating value? Or merely creating excitement? Let's begin with the simplest question. How does a business actually become richer? Most people answer, when sales increase. That's only half the truth. Imagine you own a grocery shop. Last year you sold goods worth 10 lakh rupees. This year, you sold 20 lakh rupees. Sounds fantastic. But what if your expenses also doubled? Did you really become richer? Not necessarily. Revenue is only the first chapter. Profit is the second. Cash flow is the third. Return on capital is the fourth. Only after reading all 4 chapters can you understand the whole story. Many investors stop after reading the first page. Professionals read the entire book. Let's look at BEML's revenue first. Over the last several years, sales have grown, but not dramatically. For a company operating in industries like defense, mining, and railways, many investors expect rapid expansion. Instead, the growth has been steady rather than explosive. Now, does that automatically make the business weak? Not at all. Because capital goods companies don't usually grow like software companies. Think about building a house. Some months nothing seems to happen. Then suddenly walls appear. Then the roof. Then the interiors. Construction doesn't move smoothly every single day. Project-based businesses behave similarly. Revenue recognition often depends on deliveries. One quarter may look disappointing. The next may surprise everyone. This is why experienced investors avoid judging such businesses based on a single quarter. Instead, they ask a different question. Is the overall trend improving? Now let's move one step deeper. Margins. This is one of the most misunderstood concepts in investing. Imagine 2 restaurants. Both sell 100 meals every day. Restaurant A earns 10 rupees on every meal. Restaurant B earns 30 rupees. Which business is stronger? Obviously Restaurant B, because it keeps more money after every sale. That's exactly what operating margin tells us. How much of every 100 rupees of revenue actually remains with the business after running its operations. Now here's something interesting about BEML. Its operating margins have not remained consistent. Some years, they improve beautifully. Then suddenly they contract. Why? Because the company operates in businesses where project mix matters. One year, it may deliver high-margin defense products. Another year, low-margin construction equipment dominates. Raw material prices change. Execution timelines shift. Large projects get delayed. All these factors influence margins. This teaches us another important mental model. Never confuse volatility with weakness. Some businesses naturally fluctuate. The key question isn't, did margins fall this quarter? The real question is, over the next 5 years, are margins becoming structurally stronger? That is what long-term investors should observe. Now let's talk about profits. Because this is where many investors become emotional. Suppose your salary falls this month. Would you immediately assume your entire career has failed? Of course not. You would first ask, why? Was there a bonus timing issue? Did taxes increase? Was there an extraordinary expense? Businesses deserve the same patience. BEML's recent profitability has disappointed many investors. Profits declined. Margins compressed. Return ratios weakened. Naturally, the market became cautious. But management tells a different story. They argue that investments made today, new plants, capacity expansion, new product development, will generate returns tomorrow. This creates a fascinating investment puzzle. Should investors believe today's numbers or tomorrow's promise? History teaches us. The answer usually lies somewhere in between. Now we reach one of my favorite concepts, cash flow. Imagine 2 friends. Both earn 1 lakh rupees every month. Friend number 1 actually receives the money in his bank account. Friend number 2 says, my customers will pay me after 12 months. Who is financially stronger? Obviously the first. This is why investors often say, cash is reality. Profit is accounting. Accounting profit can be influenced by timing. cash is much harder to manipulate. Now BEML has historically generated operating cash flow, which is encouraging. But there's another challenge. Working capital. This sounds complicated. Let's simplify it. Imagine you own a furniture shop. You manufacture tables today, but your customer promises to pay 6 months later. Meanwhile, you've already paid workers, purchased wood, paid electricity, covered transportation. Your money remains locked inside the business. That is working capital. BEML faces exactly this challenge. Government projects, large industrial contracts, and defense supplies often involve longer payment cycles. Money stays locked for extended periods, which means even though the company may be profitable, cash doesn't always arrive quickly. This explains why investors closely monitor debtor days and working capital in businesses like BEML. It's not merely an accounting number. It's the speed at which money returns home. Now comes one of the most important measurements in investing: return on capital employed, or ROCE. Don't worry if the name sounds intimidating. Let's simplify it. Imagine two farmers. Both own farmland worth 1 crore rupees. Farmer A earns 5 lakh every year. Farmer B earns 20 lakh. Same land, different productivity. Who is using his assets more efficiently? Farmer B. ROCE measures exactly that. It asks, how efficiently does management convert invested money into operating profits? This is one of the favorite ratios of professional investors, because businesses don't become extraordinary simply by becoming larger. They become extraordinary by becoming more productive. Now here's where BEML still has work to do. Its return ratios remain below what investors generally consider world-class. The company is building factories, launching products, winning orders, but those investments must eventually produce stronger returns. Otherwise, shareholders may begin asking difficult questions. This leads us to another beautiful mental model: the flywheel effect. Imagine pushing a giant flywheel. Initially, nothing happens. You push harder. Still nothing. Again, again, again. Then suddenly, it begins moving. Once momentum builds, the wheel keeps spinning with less effort. Many great businesses work exactly like this. Heavy investment first, higher productivity later, better margins afterward, then stronger cash flow, then better returns. Finally, higher valuations. The important question for BEML investors is this: is management currently building the flywheel, or merely pushing it without results? Only time will answer that. Now let's discuss valuation. This is where investing becomes both science and psychology. Many people think valuation simply means looking at the PE ratio. That's like judging a person only by height. Useful, but incomplete. Professional investors use multiple lenses. Let's explore them one by one. The first is price to earnings, or PE. Think of it like buying a rental apartment. If the apartment earns 1 lakh rupees every year, and you're paying 20 lakh, you're paying 20 times annual income. That's essentially what a PE ratio represents. Right now, BEML's earnings multiple appears expensive compared with many industrial peers. At first glance, that looks worrying. But here's the twist. Sometimes businesses appear expensive because current profits are temporarily depressed. If profits recover sharply, today's expensive valuation may suddenly look reasonable. This is called earning into the valuation. The market isn't always paying for today's earnings. Sometimes it's paying for tomorrow's. The second lens is price to book value. Imagine buying a factory. One approach is asking, what are the buildings, land, and machinery worth? That's book value. For asset-heavy businesses like BEML, this ratio deserves attention. However, never assume every asset automatically creates wealth. A factory producing nothing has little economic value. Assets become valuable only when they generate profits. That's why price to book alone can never be the final answer. The third model is discounted cash flow, or DCF. The name sounds intimidating, but the idea is wonderfully simple. Imagine your friend promises to give you 100 rupees every year for the next 20 years. Would you pay 2000 rupees today? Probably not, because future money is worth less than present money. DCF simply estimates today's value of tomorrow's cash. For BEML, this model becomes highly sensitive. Why? Because future profitability remains uncertain. If management executes well, the estimated value rises dramatically. If execution disappoints, that value falls equally quickly. Then comes replacement value. Suppose someone wanted to build another BEML from scratch. How much would it cost? Factories, engineering talent, testing facilities, government certifications, research centers, defense approvals, manufacturing ecosystem. Would it be easy? Certainly not. Replacement value reminds investors that some businesses possess capabilities which cannot be recreated overnight. Sometimes, that hidden value isn't fully visible inside traditional accounting numbers. Another useful framework is earnings power value. This model asks a beautiful question. If BEML stopped expanding today and simply continued operating efficiently, what would the existing business itself be worth? This separates operational strength from future optimism. Then comes sum of the parts, often called SOT. Imagine owning a fruit basket. Inside are apples, mangoes, oranges, bananas. Instead of pricing the basket as one item, you value every fruit separately. Then add everything together. BEML operates across defense, railways, mining, construction, exports, and engineering. One day, the market may begin assigning different values to different businesses rather than treating everything as one company. Finally, let's discuss something that has become increasingly important: value versus quality. Years ago, investors mainly searched for cheap stocks. Today, markets have evolved. Professional investors increasingly ask a different question. Is this company becoming better every year? Imagine two bicycles. One costs 5,000 rupees. The other costs 10,000. If the second bicycle lasts 10 years, requires fewer repairs, and gives a smoother ride, which one is actually cheaper? Sometimes, the expensive choice becomes the better value. Businesses work exactly the same way. This is why modern investing increasingly focuses on quality at a reasonable price rather than simply low price. Now, where does BEML fit? It's not a textbook value stock, nor is it yet a textbook quality compounder. Instead, it sits somewhere in between. A business with improving strategic positioning, strong national relevance, significant long-term opportunities, but financial ratios that still need to catch up. That combination makes the investment decision more nuanced. You're not simply buying today's numbers. You're buying the possibility that tomorrow's numbers become significantly better than today's. And that is exactly why opinions on BEML differ so widely. Some investors see expensive valuation. Others see future earnings. Some see weak return ratios. Others see a business investing for the next decade. Both sides are looking at the same company, but through different lenses. And that's the beauty of investing. The market is rarely a battle between right and wrong. It's usually a battle between different versions of the future. In the next chapter, we leave the world of financial statements and step into the world of market psychology. We'll decode why institutions seem to become interested before the crowd, how price quietly reveals information long before headlines do, why seemingly unrelated signals often begin pointing in the same direction, and how to distinguish genuine institutional accumulation from temporary excitement without relying on price levels, and by understanding the behavior of smart money through simple mental models anyone can grasp. Reading the invisible footprints, how institutions quietly tell their story before the headlines do. Imagine you walk into a forest early in the morning. You don't see the tiger. You don't hear the tiger. But suddenly, you notice something. Fresh footprints, broken branches, a disturbed patch of grass, silence. Now let me ask you something. Would you say, there is no tiger because I can't see it? Or would you quietly conclude, something big has passed through here? Professional investors think exactly like that. They don't always wait to see the tiger. They study the footprints. Because in the stock market, by the time everyone finally sees the tiger, the smartest participants have usually finished their work. And that brings us to one of the biggest misconceptions in investing. People believe institutions buy stocks in one day. Reality is very different. Institutions buy the way an elephant walks through a jungle. Slowly, patiently, methodically, without attracting unnecessary attention. Think about this. If a mutual fund wants to buy shares worth hundreds or even thousands of crores, can it simply press one button? Of course not. If it tries to buy everything immediately, the stock price itself would run away. It would end up paying more for every additional share. That's like walking into a vegetable market and loudly announcing, I want to buy every tomato in this market. What happens next? Every shopkeeper increases the price. Institutional investors know this, so they behave differently. They buy gradually, sometimes over weeks, sometimes over months, sometimes over an entire year. And that gradual buying often leaves tiny clues. Not obvious clues, subtle ones. This introduces one of my favorite mental models, the iceberg model. Whenever you see an iceberg floating in the ocean, how much of it is actually visible? Only a small portion, almost 90%, remains underwater. The stock market behaves exactly the same way. News is visible. Television debates are visible. Price movements are visible. But the real process that creates those movements often remains hidden. Institutional research, management meetings, industry studies, channel checks, product evaluations, order book analysis, capacity expansion, competitive positioning. Most of this happens quietly, months before television begins discussing the company. This is why experienced investors don't merely react to headlines. They try to identify whether the iceberg beneath the water is growing larger. Now think about BEML. Over the past few months, something interesting appears to be happening. Different pieces of information have started pointing in the same direction. The company is talking about record order visibility. It is expanding manufacturing capacity. It is increasing its focus on defense. It is entering newer technologies. Exports are gradually becoming more meaningful. Its product pipeline is becoming broader than before. Individually, none of these developments guarantee success. But together, they begin forming a pattern. And investing is often about recognizing patterns before they become obvious. Let's understand another important mental model. Imagine standing outside a hospital. One ambulance arrives. Nothing unusual. 2 ambulances arrive. Still normal. But imagine 20 ambulances arriving one after another. Suddenly your brain tells you, something important must have happened. Notice something. You still don't know exactly what happened. But multiple independent signals are pointing towards the same conclusion. Markets work exactly like this. One positive sign can be accidental. 2 can be coincidence. But when business developments, management actions, sector trends, and market behavior begin moving together, the probability of something meaningful increases. Not certainty, probability. And successful investing is never about certainty. It is about improving probabilities. Now let's talk about price. Most people believe price predicts the future. Actually, price reflects collective opinion about the future. Those are 2 completely different ideas. Imagine 2 friends discussing tomorrow's weather. One believes it will rain. The other expects sunshine. Neither controls tomorrow. They're simply expressing expectations. Similarly, the stock market isn't predicting. It is constantly voting. Millions of participants cast votes every day. Some buy, some sell, Some weight. The price you see on your screen is simply the current result of that voting process. Benjamin Graham beautifully described this decades ago. He said, "In the short run, the market is a voting machine. In the long run, it becomes a weighing machine." What does that actually mean? Imagine a popularity contest. The most famous student wins. That is voting. Now imagine an engineering examination. Only knowledge matters. That is weighing. Stock prices initially respond to excitement, fear, and narratives. Eventually, they respond to earnings, cash flows, and business quality. The journey from voting to weighing is where long-term investors make money. This brings us to momentum. Many people misunderstand momentum. They think momentum means chasing fast-moving stocks. Actually, momentum is much deeper. Imagine pushing a child on a swing. The first push barely moves it. The second push helps. The third push builds rhythm. Eventually, the swing begins moving smoothly with surprisingly little effort. Momentum works similarly when multiple positive developments continue reinforcing each other. Business improvement begins creating financial improvement. Financial improvement attracts institutional attention. Institutional participation improves market confidence. Improving confidence attracts more investors. This creates a positive feedback loop. Economists call this reflexivity. Most people simply call it momentum. The important thing is understanding where momentum comes from. It doesn't begin on the chart. It begins inside the business. The chart simply becomes its mirror. Let's discuss another mental model. The domino effect. Imagine placing hundreds of dominoes in a long line. The first domino doesn't create much excitement. But once it falls, every domino behind it begins falling automatically. Great businesses often develop similarly. One successful defense contract improves credibility. Better credibility helps win larger contracts. Larger contracts improve revenue visibility. Higher visibility encourages investment. Investment improves manufacturing capability. Better capability helps secure even bigger projects. One improvement quietly triggers another. The market often notices only the last domino. Professional investors try to identify the first one. Now think about something else. Why do some companies remain unnoticed for years and then suddenly become everyone's favorite? Did the business change overnight? Usually not. The perception changed. And perception often changes after evidence accumulates. Imagine a student scoring average marks for 5 years. Then suddenly, he ranks first in 3 consecutive examinations. Teachers begin noticing. Friends become curious. Parents gain confidence. Nothing magical happened overnight. The evidence simply became impossible to ignore. Stocks experience similar transformations. Sometimes businesses improve quietly while investors remain skeptical. Then gradually, the evidence becomes overwhelming. That's often when narratives change. But this is also where danger begins, because markets frequently swing from excessive pessimism to excessive optimism. Suppose a restaurant serves excellent food for many years. Initially, nobody notices. Then one food blogger writes about it. Soon another. Then television channels. Suddenly there are queue outside every evening. Has the food become dramatically better overnight? Probably not. Popularity increased faster than reality. Markets behave exactly the same way. This is why intelligent investors continuously ask, am I buying improving reality or increasing popularity? There is a huge difference. Reality creates wealth. Popularity often creates volatility. Now let's connect this back to BEML. Today, the company appears to be standing at an interesting intersection. Its strategic positioning is improving. Government policies remain supportive. Defense opportunities continue expanding. Rail infrastructure remains a long-term priority. Mining demand is linked to industrial growth. Exports are gradually increasing. Management is investing for future capacity. These are all positive ingredients. But ingredients alone do not make a delicious meal. Execution does. The market knows this, which is why you often see optimism mixed with caution. Some investors focus on the opportunities. Others focus on current profitability. Both are watching the same company, but they are standing on different sides of the bridge. One side is looking at the future. The other is looking at the present. Eventually, the two must meet. This introduces perhaps the most powerful mental model in investing: the bridge between narrative and numbers. Imagine an architect showing you a beautiful blueprint of a skyscraper. Would you immediately value the project as if the building already exists? No, because blueprints are possibilities. Buildings are realities. Businesses also move through similar stages. First comes the idea, then investment, then execution, then revenue, then profit, then cash flow. Finally, shareholder wealth. The market constantly tries to estimate where a company stands on this bridge. BEML appears to have crossed the stage of merely imagining the future. Factories are being built. Products are being launched. Orders are being won. But investors are still waiting for the last and most important confirmation. Can these strategic initiatives consistently translate into stronger earnings, higher returns on capital, and sustained cash generation? That answer will ultimately decide whether today's narrative becomes tomorrow's wealth creation story. And this brings us to the biggest lesson of this entire chapter. Never fall in love with a chart. Never fall in love with a story. Never fall in love with management presentations. Instead, fall in love with evidence. Because evidence has a beautiful habit. It keeps compounding, quarter after quarter, year after year, until eventually, even the market has no choice but to acknowledge it. In the final chapter, we'll bring everything together. We'll combine the business story, sector tailwinds, management vision, financial quality, valuation, and market psychology into a single investment framework. More importantly, we'll answer the question every investor eventually asks. If this were your own capital, would you simply admire BEML from a distance? Or would you seriously consider becoming a long-term partner in its journey? The final verdict: would you buy the story, the business, or wait for the numbers? Imagine you are standing at a railway station. Two trains are waiting on different platforms. The first train looks old. Its engine is making noise. It has already traveled thousands of kilometers. Nobody knows where it is going next. The second train looks brand new. The route map says it is heading toward a promising destination. The engine has just started. The passengers are slowly boarding. Now imagine someone asks you, which train would you invest in? You would probably ask one question before answering. Has the second train actually started moving? Or is it only announcing that it will? That, in one simple question, captures the entire investment debate around BEML. Because BEML is no longer just an old government-owned engineering company. It is trying to reinvent itself. The question is not whether the opportunity exists. The question is whether execution can transform that opportunity into shareholder wealth. And those are two very different things. Let's step back for a moment. Throughout this documentary, we've explored BEML from every possible angle. We understood why government policies matter, why defense manufacturing has become a national priority, why infrastructure spending creates long-term demand, why mining remains the invisible foundation of industrial growth, why railways are becoming more than just transportation, why exports can diversify future revenue, why management is investing heavily for tomorrow rather than protecting yesterday. Then we opened the financial statements. We celebrated the strengths. We questioned the weaknesses. We examined valuation. We analyzed market psychology. We tried to understand not just what the company is, but what it is becoming. Now it's time to connect all those pieces. Imagine solving a 1,000-piece jigsaw puzzle. At first, every piece looks unrelated. A blue piece, a green piece, a white piece. Nothing makes sense. Then suddenly, One corner appears, then another. Gradually, an entire picture emerges. Investing works exactly the same way. Quarterly results are one puzzle piece. Management guidance is another. Sector tailwinds are another. Valuation, cash flow, technology, competition, government policy, market behavior. Each piece alone tells very little. Together, they reveal the complete picture. And today's picture tells us something very interesting. BEML is no longer merely selling heavy machinery. It is quietly transforming into a strategic engineering company aligned with India's long-term priorities. Think about those priorities once again. A stronger defense ecosystem, modern railways, high-speed transportation, mining expansion, infrastructure development, domestic manufacturing, export competitiveness. If someone were designing an engineering company specifically to participate in these themes, it would probably look surprisingly similar to BML. That itself is a meaningful advantage, because investing becomes easier when a company is swimming with the economic current rather than against it. Now let's discuss something most investors misunderstand. People often ask, is this stock cheap? But perhaps a better question is, cheap compared to what? Imagine someone offers you an apartment for 1 crore rupees. Expensive? Maybe. But what if every nearby apartment costs 2 crores? Suddenly it looks attractive. Now imagine another apartment selling for 50 lakh rupees. Very cheap. But the building has structural cracks, water leakage, legal disputes. Now which apartment is actually expensive? The cheaper one. This is why professional investors rarely chase absolute cheapness. They chase mispricing. There's a beautiful difference. Cheapness simply looks at today's price. Mispricing compares today's price with tomorrow's potential. This brings us to one of the most important investing frameworks: value versus quality. Years ago, investors believed buying low-quality businesses at low prices was enough. Experience proved otherwise. A weak business often remains weak. A cheap business can remain cheap for years. Imagine buying an old bicycle because it's inexpensive. Every month you spend money repairing it. Eventually, you realize the expensive bicycle would actually have cost less. Businesses work exactly the same way. Quality compounds. Weakness compounds too. That's why modern investing increasingly prefers businesses where quality is improving, even if they aren't the cheapest available. Now ask yourself honestly, where does BML fit? Is it already a world-class quality company? Not yet. Is it a broken business? Definitely not. Instead, it sits in one of the most fascinating categories in investing. A company attempting to move from average quality towards higher quality. And those transitions often create enormous opportunities, provided execution succeeds. Another mental model helps explain this beautifully. Imagine renovating an old heritage house. The foundation is strong. The location is excellent. But the interiors need modernization. The electrical wiring must be replaced. The plumbing upgraded. The roof repaired. During renovation, the house looks messy. Dust everywhere. Construction materials scattered around. Visitors wonder whether anything positive is actually happening. Then one day, everything comes together. Suddenly, the same house becomes one of the most beautiful properties in the neighborhood. Businesses also go through renovation phases, capacity expansion, technology upgrades, product diversification, management transformation. These periods often appear financially untidy. Expenses rise before profits do. Investment comes before returns. This is precisely why patient capital sometimes earns extraordinary rewards. Not because it predicts perfectly, but because it understands timing. However, this is where discipline becomes more important than optimism. One of Charlie Munger's favorite ideas was inversion. Instead of asking, "Why should I buy this company?" he suggested asking, "Why could this investment fail?" Let's apply that thinking. Suppose defense orders slow. Suppose project execution gets delayed. Suppose margins remain weak. Suppose working capital continues consuming cash. Suppose return on capital refuses to improve. Would today's optimism still look justified? These are uncomfortable questions. But intelligent investors ask uncomfortable questions before investing, not afterwards. Now let's invert the question again. Suppose management executes well. Factories begin operating at higher utilization. Defense contribution keeps increasing. Railway projects accelerate. Exports expand. Margins recover. Cash flows strengthen. Return on capital improves. What happens then? The market usually doesn't reward just higher earnings. It rewards improving confidence. And improving confidence often changes valuation itself. This creates something investors love. A double engine. One engine comes from growing profits. The second engine comes from investors becoming willing to pay higher multiples for those profits. When both engines work together, wealth creation accelerates dramatically. Now think about something we've quietly discussed throughout this documentary. At no point did we rely on one single piece of evidence. Instead, we looked for convergence, government policy, business transformation, sector opportunities, management actions, financial direction, market behavior. This approach comes from another powerful mental model, the mosaic theory. Imagine trying to identify a person from one tiny photograph. Impossible. Now imagine collecting 50 small photographs taken from different angles. Suddenly, the identity becomes obvious. Professional investors rarely depend on one indicator. They build mosaics. Every small clue adds another tile. One clue may be wrong, two may mislead, but dozens of independent clues pointing toward the same conclusion become increasingly meaningful. That is how conviction is built, not through certainty, through evidence. Now let's return to the market itself. Markets have an interesting habit. They almost never ring a bell saying, "The best buying opportunity begins today." Nor do they announce, "This stock has become fully valued." Instead, they slowly change their behavior. First, only a few people notice. Then industry experts. Then institutional investors. Then financial media. Finally, the general public. The greatest wealth in investing is usually created before the last stage begins, not after. So, would I call BEML a guaranteed multibagger? No. No honest investor should use that language. Would I call it risk-free? Certainly not. Every investment carries uncertainty. But would I say BEML deserves a place on the watch list of anyone interested in India's long-term defense, rail and infrastructure story? Absolutely. Because the company is no longer interesting merely for what it has achieved. It is interesting because of what it is attempting to become. And markets often reward businesses during periods of successful transformation. So here's perhaps the biggest lesson from BEML. Sometimes investing isn't about finding perfect companies. It's about recognizing companies becoming less imperfect every year. There is a profound difference. Great investing rarely begins with perfection. It begins with improvement. And improvement, when sustained over many years, becomes quality. Quality becomes trust. Trust attracts long-term capital. Long-term capital supports valuation. And valuation, combined with growing earnings, creates wealth. Before we end, I want you to remember one image. Imagine standing at the edge of a massive construction site. Today, you see cranes, dust, noise, concrete, steel. Nothing looks beautiful. But the engineer standing beside you smiles. Because he isn't looking at today's construction site. He's already imagining tomorrow's skyline. Investing requires exactly the same mindset. Sometimes the market only sees today's dust. The patient investor tries to imagine tomorrow's skyline. Whether BEML ultimately becomes one of the defining engineering companies of India's next decade will depend on management's ability to convert ambitious plans into consistently better financial performance. That story is still being written. And perhaps that's what makes it so fascinating. So the next time you hear words like Atmanirbhar Bharat, Make in India, PM Gati Shakti, Defense Indigenization, or Viksit Bharat 2047, don't just think about government announcements. Ask yourself a different question. Which businesses quietly manufacture the muscles that make those dreams possible? Because sometimes, the most important companies are not the ones making the headlines. They're the ones building the nation while everyone else is busy watching the ribbon-cutting ceremony. And maybe, just maybe, BEML is one of those silent builders. So here's a question to leave you with. When India's next decade of infrastructure and defense growth is written into history, do you think BEML will merely be a spectator, or one of the companies helping write that history? That is not a question the market can answer today. Only time can. And in investing, time is often the final judge.
Don't forget to like and subscribe.